JPMorgan Chase, you hear that name and you just think global finance, right? It's a true titan of the industry. But right now, with its stock hanging out near all-time highs, it's also a company at a really critical tipping point. Okay, let's dive into this and figure out if this financial giant is a rock-solid investment or maybe a disaster waiting to happen. And if you're wondering what the view from the top is, well, it's pretty confident. Chairman and CEO Jamie Dimon was just celebrating a massive quarter. I mean, we're talking nearly $14.5 billion in net income and a super impressive 20% return on tangible common equity. By all accounts, the machine is absolutely humming. But this is the big question we're here to answer, isn't it? When a company looks this good and everybody knows it, has the price been pushed up to a dangerous peak? Have we already missed the boat, or is now the perfect time to jump on board? That's exactly what we're going to figure out.
To even start to answer that, you first have to understand the sheer incredible scale of JP Morgan's power. This is not just another bank.
No, it's more like a financial fortress. Its strength really comes from this deeply diversified business model and a size that, honestly, few can even comprehend, let alone try to compete with. Let's just look at one key metric to see what I mean. In the high-stakes, high-margin world of investment banking, JP Morgan is number one, period. They're always at the top of the charts, which means they're handling the biggest deals. And that tells you a lot about their influence and their earning power. Now, what's really cool is how the whole business is built on three massive engines. You've got the consumer and community bank, which serves millions of people like you and me. Then there's the corporate and investment bank. That's the global powerhouse we just talked about. And finally, the Asset and Wealth Management Division, a quiet giant that manages a staggering $4.6 trillion. Each one is a fortress on its own. And this number right here, this might just be their biggest competitive advantage. $18 billion. That's what they invest in technology every year. This isn't just about having a slick mobile app. We're talking about using AI to spot fraud better than anyone else, or building trading platforms that are faster and more reliable. It's about creating a technological moat so wide and so deep that smaller rivals, they simply can't cross it. But every engine, no matter how powerful it is, faces some resistance. So let's take a look at the headwinds that could really slow JP Morgan down. Even for a company this huge, the horizon is not perfectly clear. Based on all the source material, there are two specific risks that are looming pretty large right now. So, first up is operational risk. Simply put, expenses are going up. Medical costs alone are projected to jump 10%. But maybe more importantly, the war for talent is absolutely fierce, and that's pushing salaries higher. Second, there's macroeconomic risk. JP Morgan's own research team thinks there's a 35% chance of a US and global recession in 2026. A recession would hit their bottom line directly because businesses and people borrow less, and unfortunately, more people struggle to pay back their loans. And on that topic of rising costs, don't just take my word for it. Jamie Dimon himself was really clear on the last earnings call. He admitted there's intense pressure from places like hedge funds trying to poach their best people, and he basically said, we're going to pay what it takes to keep them. The takeaway here is higher expenses seem pretty much unavoidable. Okay, so we've looked at the strengths and we've looked at the risks. Now let's decode the numbers that really, really matter. Think of revenue growth like the accelerator pedal on a car. It tells us if the business is speeding up or if it's hitting the brakes. It's a really basic but super important measure of momentum. And JPM's managed revenue grew 9% year over year last quarter. So yeah, they are definitely picking up speed, not slowing down. The foot is on the gas. All right, next up is ROTCE, or Return on Tangible Common Equity. I know it's a mouthful, but this is a huge metric for banks. It basically just asks, for every dollar of our shareholders' money that we've invested in the business, how much profit are we actually generating? It's a pure and simple measure of profitability. And JP Morgan's answer to that question is 20%. Let me just say, that is an elite number. It means they have a highly profitable, incredibly efficient operation that's creating a ton of value for its shareholders. Finally, let's talk about the CET1 capital ratio. The best way to think about this is as a financial shock absorber. It's the cushion of high-quality cash that the bank keeps on hand to survive a crisis without failing. You want this number to be high. A bigger number means a bigger cushion. JPM's ratio is 14.8%, which is well above what the regulators require.
This tells us the bank is extremely well capitalized. It's built to withstand some serious financial stress. That fortress we talked about, it is solid. Okay, so the business is a fortress and the engine is firing on all cylinders. But what is the price of all that dominance? Because this, my friends, is where the story takes a very sharp turn.
Let's start with a really basic valuation measure, the price-to-earnings ratio. Right now, JPM is trading at a PE of almost 16. But its average over the last 10 years is under 12. You see where I'm going with this? You are paying a 33% premium today compared to its historical average. The market has priced in a lot of good news here. And it's not just expensive compared to its own history. JPM also trades at a premium to its direct competitors, like Bank of America and Wells Fargo. Now, investors are clearly paying up for JPM's quality, but the question is, how much of a premium is just too much? We've seen the powerful case for buying, and we've seen the worrying case against it on valuation. So now it's time to put it all together and give you the final verdict. Based on a deep dive into all the source materials, the recommendation is a sell. Now, despite the company's incredible strengths, the price just appears to have run too far, too fast. The 12-month price target, which we've derived from a data-driven valuation analysis, is $252.91 per share. What that model is telling us by comparing JPM's numbers to its peers and its own history is that the stock is currently overvalued by about 21%. Let's just recap. The strongest argument for buying is undeniable. You are getting an absolute best-in-class financial institution with unmatched leadership and truly elite profitability. But the deciding factor against it is equally clear: the valuation. The stock is simply priced for a perfect future, and that leaves very little room for error and a pretty significant risk of downside if any of those headwinds start to pick up. So, if you agree with the idea that JPM is overvalued, but you still want some exposure to the big U.S. banking sector, what's the alternative play? Well, looking at this direct comparison from the source data, you can see that competitors like Bank of America and Wells Fargo trade at lower price-to-earnings ratios. But more importantly, look at their price-to-book ratios. They are significantly lower. For banks, this is a key metric, and it suggests you can buy their assets for a much cheaper price. You're getting exposure to the same industry, but with a potentially greater margin of safety. Look, JPMorgan Chase is a phenomenal company, but at its current price, the source materials suggest it might not be a phenomenal investment. The key takeaway here is that even the best companies can become overvalued, and the price you pay is what determines your return. This brings up a critical question for any investor. Are you buying a great company, or are you buying a great stock? Let us know in the comments what company we should analyze next.